Hello, my name is Mayanka. I am accounts and finance trainer from Uplatz. Today we will discuss one of the important concept of income tax. One of the important concept of income tax. Charge and rate of taxes. Rate of income tax. At what rate the income will be taxable in the hands of person? At what rate? What will be the income tax rate under the Income Tax Act? And at what rate the income will be taxable in the hands of assessee or in the hands of person? In this class, we will discuss the rate of income tax at which the income will be taxable in the hands of individual, AOP, BOI, company, firm, artificial judicial person, and other person. We will cover such a topic into two parts. We will cover such topic into two parts. This is part one of charge and rates of income. Rates of income tax. So now we will start our discussion on such important topic. Number one, we will discuss charge of income tax. Charge of income tax. Section 4 of the Income Tax Act 1961 is a charging section. Section 4 of the Income Tax Act 1961, it is the charging section, and the charging section of the Income Tax Act provides a charging section of the Income Tax Act 1961 provides that the tax shall be charged at the rate. The income tax on the income will be charged at the rates which are prescribed by the Annual Finance Act or by the Income Tax Act 1961 or both. The the income tax on the income which be chargeable, it will be chargeable at the rate which are prescribed, for the year, relevant year by the Finance Act. Means the Annual Finance Act contain the provision of rates for such particular year, or the rate which are described in, or which are present in, or which are prescribed in Income Tax Act or both. Means we will determine the rate of tax through the, or by the Annual Finance Act or Income Tax Act 1961 or by both. Number two, the charge is on every person prescribed under Section 2, subsection 31. The charge is on every person. As per the Income Tax Act, the definition of the person includes individual, HUF, AOP, BOI, company, firm, artificial judicial person. These all are considered as person. And the provision of the income tax will be applicable on all the provisions. And Section 4 is also applicable on all the persons. As per the provision of income tax, the income which is earned by the person during the previous year, it will be taxable in the assessment year. The tax is chargeable on the total income. The tax is chargeable on the total income of the assessee which is earned by him in the previous year, and not in the assessment year. Is that there are, as per the normal provision of the Income Tax Act, the income which is earned by the assessee in the previous year, will be taxable in the next year or in the assessment year. The income which is earned by the assessee in the previous year will be taxable in the assessment year. But there are some exceptions. Where the income will be taxable in the same year, just like shipping business of non-resident and person who is leaving India. In the case of discontinued operation, and there are some exception in which such provision is not applicable. In this case, such provision is not applicable. Is that, for the example, Mr. Ram, he earned salary income of rupees 6 lakh 50,000 rupees per month in the previous year 20 and 21. Then such income will be taxable. Such income will be taxable in 21 and 22. Means the assessment year, in the assessment year 21 and 22, such income will be taxable. This is the normal provision. This is the normal provision. But there are some exceptions. But there are such exceptions. Just like the person leaving India. If there is any person who is leaving India, then such income will be taxable. If the person leaving India, and according to the, or as per the expectation of AO, he will not come. Means there is no intention to come back in India. There is no intention that he will come back to India. So in this case, the income, if he earn 2,50,000 rupees in 20 and 21, 20 and 21 before leaving the India, then such income will be taxable or assessed. Such income will be assessed in 20 and 21. Such income will be assessed in the year 20 and 21, not in 22, sorry, 21 and 22. It will be assessed in the same year. When the person leaving India, these are the exception of the normal provision. There are some exceptions of the normal provision in the case of discontinued operation, in the case of shipping business of non-resident, in the case of when there is any person transferring any assets to avoid the taxation. These are the exceptions where the income will be taxable in the same year. The income will be taxable in the same year. The income tax shall be levied in the accordance with and subject to the various provisions which are contained in Act. The taxation of the income shall be made on the basis of or subject to the various provision of the Income Tax Act. Means we will calculate the amount of tax on any of the income on the basis of provision of the Income Tax Act. So this is the charging section. This is the charging section, section 4. Section 4 is the charging section of Income Tax Act, and it is very much important section because it is create charge. It is create the charge of tax on the income. So now we will understand the rate of income tax. Now we will understand the rate of income tax. The rate of taxes which are applicable on person, on the different person. Number one, income tax is charged at the fixed rate. The income tax is charged at the fixed rate. The rate which are prescribed by the Annual Finance Act. The Annual Finance Act, which is issued by the Finance Minister, contain the rates of income tax which will be applicable on the person, and these rates are changed. These rates are changed year to year basis as per the requirement. Means the Finance Minister change the rates of tax year to year basis. Or they may change the basic exemption limit. So the income tax rate are fixed on the basis of Annual Finance Act. Is that there is a Finance Act 2020 and 21 which is applicable. Means the Finance Act 2020 contain the provision. It is contain the provision of rates of tax, and these rates of tax will be applicable for the assessment year. These rate will be applicable for the assessment year 20 and 21. Is that we will consider the rate of Finance Act for the calculation of income tax. Section 2 of the Finance Act 2020, Section 2 of Finance Act 2020. Read with part 1. Of first schedule of the Finance Act. Specify the rate. Schedule 1 of Finance Act 20, Section 2. Specify the rate at which the income will be taxable. Means it will contain or it will specify the rate of income tax. It will specify the rate of income tax is to be levied, means the tax which is levied on the income, and the income which is chargeable to tax for the assessment year 20 and 21. Section 2 of the Finance Act 2020, read with part 1. Read with part 1 of schedule first. It is specify the rate of income tax. The rate of income tax which is to be levied on the income. Such rate will be levied on the income. The income which is chargeable to tax, the income which is chargeable to tax for the assessment year 20 and 21. The income which is chargeable to tax for the assessment year 20 and 21. This is part 1. Part 2. Part 2 specify the rate of TDS. Part 2 specify the rate of TDS. Part 2 of Schedule 1 of Finance Act 2020 contain the rates of TDS, contain the rate of TDS during the financial year 20 and 21 from income, subject to a deduction under the Income Tax Act. Means part 2 of Schedule 1 contain the provision of or contain the rate of TDS. Contain the rate of TDS. And part 3 lays down, the rate of charging of income tax in the certain cases. Rate of deducting income tax from income chargeable under the head of salary, and the rate and the rules and the rates for computing the advance tax for the financial year 20 and 21. Part 2 contain the provision. Part 2 contain the provision of rates of income tax which will be applicable on specific income. The rate of income tax which is applicable on the specific income, and it is also contain the provision of rate of TDS, rate of deducting the income which will be taxable under the head of salary. And part 3 also contain the rates for computing the advance tax. And the part 3 also contain the rates for computing the advance tax for the financial year 20 and 21. Part 1 contain the rates of income tax, part 2 contain the rates of TDS, and part 3 contain the rates of tax for the certain cases, for the specific cases, and the income which will be taxable under the head of salary. And it is also contain the rates for computing the advance tax for the assessment for the financial year 2020 and 21. Part 3 of the first schedule of the Finance Act 2020 will become part 1 of the first schedule to the Finance Act 2021, and so on. Means the part 3 of the first schedule, which will contain the rate of advance tax calculation, salary which is taxable under the head of salary head, and rates for certain cases. It will become the part 1. It will become part 1 of first schedule. It will become part 1 of first schedule to the Finance Act 2021, and so on. So now we will discuss the rates of taxes. Now we will discuss the rate of taxes. Means first we will discuss slab rate. Now we will discuss the slab rate which are applicable for the assessment year 21 and 22. The slab rate for the assessment year 20 and 21, 21 and 22 means financial year or the previous year, the income which is earned in previous year 20 and 21. The rate of tax will be applicable on such income. Is that the slab rate which is applicable for 21 and 22 are as follows. The income which is earned by the assessee in the previous year 2020 and 21 will be taxable in the assessment year 2020 and 2021 and 22. And the following rate will be applicable. Number 1, in the case of individual, in the case of HUF, in the case of AOP, and in the case of BOI, or in the case of artificial judicial person. In the case of individual, in the case of Hindu undivided family, in the case of art association of person, in the case of body of individual, and in the case of artificial judicial person, the tax rate are as follows. Number one, individual whose age up to 60. In the case of individual, the age is 60. The rate are as follows. Number one, where the total income of the assessee does not exceed 2,50,000. The income of the assessee does not exceed 2,50,000. Then the rate of tax will be nil. If there is any assessee whose income is less than or up to 2,50,000, then his income will not be taxed, means the tax rate will be zero. He is not required to make the payment of any tax. For the example, sorry, for the example, there is a assessee, Mr. Ram. Mr. Ram, he is an individual. He is an individual, and his age is 30 years. His age is 30 years. Total income for the previous year 2020 and 21 is it is 2,30,000. It is 2,30,000. In such case, the income is less than 2,50,000. The tax will be zero. Tax will be zero. The tax will be zero. If there is any assessee whose taxable income is less than rupees 2,50,000, then there is no need to make the payment of any tax. There is no need to make the payment of any tax, means this is the basic exemption. 2,50,000 rupees is the basic exemption. Number two, where the total income is more than 2,50,000, where the total income of the assessee is more than 2,50,000 but up to 5 lakh. If there is any assessee whose total income, whose taxable income or total income is more than 2,50,000 but up to 5 lakh rupees, then 5% of income by which income exceed 2,50,000, means the income in excess of 2,50,000. If the income is more than 2,50,000 but up to 5 lakh rupees, then the excess income, the excess from 2,50,000 will be taxable at the rate of 5%. The excess income, the excess from 2,50,000 will be taxable at the rate of 5%. It will be taxable at the rate of 5%. For the example, Mr. Ram, Mr. Ram, his age is 30 years. His age is 30 years and the total income for the assessment year is 3,75,000. 3,75,000. In such case, the tax will be up to 2,50,000. It will be zero. Up to 2,50,000. Up to 2,50,000. It will be zero. It will be zero. More than 2,50,000, but up to 5 lakh. But up to 5 lakh. So in this case, his income is more than 2,50,000. His income is more than 2,50,000. So the excess income more than 2,50,000 will be taxable at the rate of 5%. At the rate of 5% is that 3,75,000 minus 2,50,000. 3,75,000 minus 2,50,000 into 5%. Into 5% means 6,250 rupees. 6,250 rupees is required to be paid by Ram. When the income is more than 2,50,000 but up to 5 lakh rupees, then the excess of 2,50,000. The excess of 2,50,000 will be taxable at the rate of 5%. It will be taxable at the rate of 5%. Where the total income exceed, when the total income of the assessee is more than 5 lakh, where the total income of the assessee is more than 5 lakh but up to 10 lakh, but not exceed 10 lakh. when total income exceed 5 lakh but not more than 10 lakh. In this case, the tax will be 12,500 plus 20% of the amount by which total total income exceed 5 lakh. Means the tax will be 12,500 plus 20% of exceed of 5 lakh. 20% of exceed of 5 lakh. For the example, Mr. Ram, Mr. Ram, he is an individual and the age is 30 years. The total income for the previous year 20 and 21 is, for the example, 8,50,000. In the respect of this, the tax will be, in the respect of this, the tax will be up to 2,50,000, it will be 0. Up to 2,50,000, it will be 0. And more than 2,50,000 but up to 5 lakh. It is more than 2,50,000 but it is also more than 5 lakh. So in this situation, the income which is more than, the income which is more than 2,50,000 but up to 5 lakh means 5 lakh minus 2,50,000 means 2,50,000 will be taxable at 5%. This 12,500 now. So it is 12,500. This one is 12,500 is this. And more than 5 lakh but but up to 10 lakh. But up to 10 lakh. In this case, his income, in this case, the tax will be more than 5 lakh. More than 5 lakh is 8,50,000 minus 5 lakh means exceed amount is 3,50,000 into 20%. In this case, the rate will be 20%. So the total tax which is paid by Mr. Ram will be when his income is more than 5 lakh but up to 10 lakh. Means if his income is 8,50,000, then he will pay 82,500 rupees. He will pay 82,500 rupees as the income tax, as income tax, as income tax. Where the total income exceeds 10 lakh, if there is any assessee whose income exceeds 10 lakh rupees, whose income exceeds 10 lakh rupees, then he is required to pay the tax at 1,12,500 plus 1,12,500 plus 30% of 30% of amount by which the total income exceeds 10 lakh. Means excess of 10 lakh will be taxable at 30%. Excess of 10 lakh will be taxable at 30%. Is that for the example? Mr. Ram, he is an individual and his total income in the previous year is 12,50,000. In this case, the tax will be, in this case, what will be the tax? What will be the tax? As per the provision, if it is more than 10 lakh, if the income is more than 12 lakh, then the excess of 10 lakh will be taxable at 30%. Will be taxable at 30%. Means more than 10 lakh. More than 10 lakh will be taxable at 30%. So in this case, the tax will be 0. Up to 22,50,000 tax will be 0. But more than 2,50,000 but up to 5 lakh, the rate will be 5%. Means it is that 5 lakh, it is more than 12,50,000 is more than 5 lakh. 2,50,000 is the basic exemption into 5%. So it will be 12,500. When income is more than 10 lakh, it is more than 10 lakh, but sorry, it is more than 5 lakh, but up to 10 lakh, then it will be taxable 20%. So as per this 1,12,500, this is 1,12,500, this one 1,12,500 plus 30% of income which is more than 10 lakh. Income is 12,50,000. The income is 12,50,000 minus 10 lakh into excess will be taxable at the rate 30%. Income excess will be taxable 30%, 75,000. So the total amount of tax which is paid by Mr. Ram in case when his income is more than 10 lakh rupees, or when his income is 12 lakh 50,000. When his income is 12 lakh 50,000, then he will pay 1 lakh 87,500. In this case, he will pay 1 lakh 87,500 rupees as income tax. He will pay as income tax. So in this situation, so in this case, when his income is up to 2 lakh 50,000, he will pay zero. He will pay nil tax. If it is more than 2 lakh 50,000 but up to 3 lakh, then he will pay, sorry, up to 5 lakh, then he will pay 5% on excess of 2 lakh 50,000. Is that up to 2 lakh 50,000? The rate of tax is zero. The rate of tax is nil. More than 2 lakh 50,000 but up to 5 lakh. Up to 5 lakh. It will be 5% of excess of 2 lakh 50,000. 2 lakh excess of 2 lakh 50,000. In the next case, more than 5 lakh but up to 10 lakh, then 12,500. This one 12,500 plus 10% of, sorry, 20%. 20% of excess of 5 lakh. Excess of 5 lakh. And more than 10 lakh, then 1 lakh 12,500 plus 30% of excess of 10 lakh. So this is in the case when, in the case of individual up to 60 years, and for HUF, AOP, BOI, and artificial judicial person. This tax rate for the 20 and 21 means for the assessment year 20, 21 and 22 as per the Finance Act, 2020. So these rate for the individual up to age 60, for the HUF, AOP, BOI, and the artificial judicial person. So on the basis of this, we have understand how to calculate tax. Where the income is up to 2,50,000, the rate will be zero, the tax rate will be nil. Where it is more than 2,50,000 but up to 5 lakh, then excess of 2,50,000 will be taxable at the rate 5%. Where the income, where total income is more than 5 lakh but up to 10 lakh, then 12,500 plus 20% of excess of 5 lakh. The income which will be more than 5 lakh will be taxable at 20%. And where the total income exceeds 10 lakh, then 1 lakh 12,500 plus 30% of excess, 30% of excess of 10 lakh rupees. Is that if there is any income which is more than 10 lakh, then such income will be taxable at the rate 30%. It is to be noted that such provision or such these rate are applicable in the case of the person whose age is up to 60 years. In the case of senior citizen and in the case of super senior citizen. In the case of senior citizen and in the case of super senior citizen, the basic exemption limit. Senior citizen means whose age is more than 60 but up to 80. Whose age more than 60 but up to 80. And super senior citizen means the person whose age is more than 80. The super senior citizen is the person whose age is more than 80. So in the case of senior citizen, first we will take, in the case of senior citizen, the basic exemption limit will be increased to 3 lakh. In the case of a senior citizen, in the case of senior citizen, the basic exemption limit is exceed to 3 lakh rupees, and in the case of super senior citizen, the basic exemption limit is exceed to 5 lakh. Means if there is any person, whose age is more than 60, whose age is more than 60 during the previous year, then the basic exemption limit of 2.5 lakh, means the normal is 2,50,000. But if the person age more than individual individual more than more than 60 years, more than 60 years, then such a exemption will be 3 lakh. It will be up to 3 lakh. Up to 3 lakh, it will be nil. Up to 3 lakh, it will be nil. And all are same. Is that more than 3 lakh, but up to 5 lakh, it will be 5%. More than 3 lakh, but up to 5 lakh, it will be 5% of excess of 3 lakh, and 5% of excess of 3 lakh, and it will be not 12,500. It will not be 12,500. It will be just like 5 lakh, sorry, 5 lakh minus 3 lakh into 5%. It will be 10,000. 10,000 plus 20% of excess of 5 lakh. Okay. And another one will be 1,10,000 plus 1,10,000 plus 30% of excess of 5, sorry, excess of 10. So there will only such type of change. Means if there is any person whose age is more than, if there is any individual whose age is more than 60 years, then such exemption limit, basic exemption limit will be increased up to 3 lakh. It will be 3 lakh. In the case of a senior citizen, in the case of senior citizen, in the case of senior citizen, now the basic exemption limit up to 3 lakh. Further, if there is any person who is a resident of India and whose age is 80 years or more than 80 years, if there is any person whose age is more than 80 years, means senior citizen is up to more than 60 years but less than but less than 80 years, and in the case of the person, in the case of the individual whose age is more than whose age is more than 80 years, whose age 80 years or more than 80 years, individual 80 year age is 80 years or more than 80 years, or more than 80 years. In this case, the basic exemption will also be changed. The basic exemption will also be changed. The basic exemption will be increased to 5 lakh. Up to 5 lakh, there will not be tax. Up to 5 lakh rupees, there will not any amount of tax. There will not be any amount of tax. And there will not be any amount of tax. And first we will discuss in the case of senior. First we will discuss in the case of senior citizen, the person whose age 60 year or more than 60 year, but up to or but not more than, sorry, but not more than 80 years. In this case, up to 3 lakh, up to 3 lakh it will be nil. Up to 3 lakh it will be nil. If it is more than 3 lakh but up to 5 lakh, then 5% of this one, 5% of excess of 3 lakh, 5% of excess of 3. More than 5 lakh but up to 10 lakh, then 10,000 plus 20% of excess of 5 lakh, 20% of excess of 5 lakh. When the total income exceeds 10 lakh, 1 lakh 10,000 plus 30% of 30% of excess of 10 lakh, 30% of excess of 10 lakh. This is in the case of senior citizen. This is in the case of senior citizen. Now, in the case of super senior citizen, in the case of super senior citizen means the person whose age is more than, sorry, whose age is 80 years or more than 80 years. So in this case, sorry, so in this case, the amount means the basic exemption will be increased to, the basic exemption will be increased to 5 lakh. It is increased to 5 lakh. Sorry. It is increased to 5 lakh. So up to 5 lakh, the tax will be nil. More than 5 lakh, but up to 10 lakh, 20%. 20% of excess of 10 lakh. 20% of excess of 5 lakh. Sorry. 20% of excess of 5 lakh. It will be 1 lakh. It will be 1 lakh. So and if the income is more than 10 lakh, then 1 lakh plus 30% of such 10 lakh. 1 lakh and the 30% of such 10. So in this situation, in the case of senior citizen, where the total income does not exceed 5 lakh, then the tax rate will be nil. If it is more than 5 lakh but up to 10 lakh, then 20% of excess of 5 lakh. 20% of excess of 5 lakh. Where total income exceed 10 lakh, then 1 lakh plus 30% of amount by which the total income exceeds 10 lakh, means 30% of income which is exceeded by rupees 10 lakh rupees by 10. So these are the tax rate, normal slab rate, in the case of individual whose age up to, whose age is less than, whose age is less than 60 years, less than 60 years, and HUF, AOP, POI. And this one, the person whose age is 60 years, 60 years or 60 years or more than 60, 60 years or more than 60 years. And these slab rate for the person whose age is 80 years or more than 80 years, or more than 80 years, more than 80 years. These slab rate will be applicable for the financial year 20 and 21, means for the assessment year 21 and 22. For the assessment year 21 and 22 is that if there is any income which is earned by the assessee in the previous year 20 and 21, then such these tax rate will be applicable according to the person, Now, as per the section 115 BAC, as per the section 115 BAC, the individual and HUF, only for the individual. Section 115 BAC is only for the individual and the HUF. The individual and the HUF, they have an option to pay the amount of tax on his total income. Means they may make the payment of tax on his total income at the concessional rate. At the concessional rate, but there are certain conditions. Is that as per the section 115 BAC, the individual and the HUF, they have an option to pay the amount of tax on his total income, other than income chargeable to tax at specific rate under chapter 12. They will pay the tax at the concessional rate, but there is the condition that they will not avail. But there is the condition that they will not avail. They will not avail. They will not avail the certain exemption, deduction like leave travel concession, standard deduction under the head of house property, interest on housing loan, interest on housing loan on self-occupied property, deduction under chapter 6, other than 80 CCD 2 and 80 JJAA. Is that if there is any individual or the HUA wants to pay the amount of tax at the according to the provision of section 115 BAC, according to this provision, he will pay, such a person will pay the amount of tax at the concessional rate, but he will not take any exemption or the reduction, but he will not avail certain exemption and the certain deduction, like the standard deduction of rupees 50,000 under the head of salary, he will not take it, and interest on housing loan on self-occupied property of rupees 2 lakh, he will not avail it. Deduction under chapter 6A, he cannot take it, but he can take the deduction of 80 CCD 2 and section 80 JJAA. So now we will discuss section 115 ABC, tax rate under section 115 BAC, section 115 BAC. If there is any assessee whose income up to rupees 2,50,000, the assessee whose income up to rupees 2,50,000, then the tax rate will be nil. The tax rate will be nil. Is that as per section 115 BAC, as per section 115 BAC. If there is Mr. Ram, his income up to 2,50,000. Up to 2,50,000 means, for the example, his income is 2,40,000. Then the tax will be zero. The tax will be zero. No tax will be there, means the tax rate will be nil. And if it is more than 2,50,000 but up to 5 lakh, more than 2,50,000 but up to 5 lakh, up to 5 lakh. Wait. Up to 5 lakh, up to 5 lakh rupees, sorry, it will be, the tax rate will be 0, and in this case the tax rate will be 5%. The tax rate will be 5%. The tax rate will be 5%. If the income is more than 2,50,000, if the income is more than 2,50,000 but up to 5 lakh, then the tax rate will be 5% of excess of 2,50,000. Excess of 2,50,000 means the tax rate, sorry, the amount of tax will be 5 lakh minus 2,50,000 into 5%. The tax will be 12,500. The tax will be 12,500 rupees. If the income is more than 5 lakh but up to 7 lakh 5,000. 7 lakh 50,000, sorry, but up to 7 lakh 50,000, then the tax rate will be 10%. then the tax rate will be 10%. Is that if the income is more than, if the income is more than 5 lakh rupees, but up to 7 lakh 50,000, then the tax rate will be 10%. Then the tax rate will be 10%. If it is more than 7 lakh 50,000, but up to but up to 10 lakh, then it will be 15%. It will be 15%. If it is more than 7 lakh 5,000, 7 lakh 50,000, but up to 10 lakh, then the tax rate will be 15%. Tax rate will be 15%. If it is more than, if it is more than 10 lakh, but up to 12 lakh 50,000, then the tax rate will be 20%. Then the tax rate will be 20%. If it is more than 10 lakh, but up to 12 lakh 50,000, the tax rate will be 20%. Tax rate will be 20%. If it is more than 12 lakh 50,000, but up to 15 lakh, then the tax rate will be 25%. If it is more than 12 lakh 50,000, but up to 15 lakh, then the tax rate will be 25%. If it is more than, if it is more than 15 lakh, then the tax rate will be 30%. The tax rate will be 30% if it is more than 15 lakh. Is that up to 2 lakh 50,000? No tax is required to be paid. Same as normal provision. If it is more than 2 lakh 50,000, but up to 5 lakh, then the tax rate will be 5%. If the income of the assessee is more than, if the income of the assessee is more than 5 lakh, but up to 7 lakh 50,000, but up to 7 lakh 50,000, then the income will be taxable at the rate of 10%. Then the income will be taxable at the rate of 10%. If it is more than 7 lakh 50,000, but up to 10 lakh, then the income will be taxable at 15%. Then the income will be taxable as 15%. If it is more than 10 lakh, but up to 12 lakh 50,000, it is, if the income is more than 10 lakh, but up to 12 lakh 50,000, then the income will be taxable at the rate 20%. If the income is more than 12 lakh 50,000, but up to 15 lakh, then the income will be taxable at the rate 25%. And the income is more than 15 lakh, then it will be taxable as 30%. Then it will be taxable as 30%. These are the tax rate as per the provision of section 115 BAC. As per the section 115 BAC, these are the concessional rate, but the assessee cannot take the deduction under chapter 6A as some other special deduction. Now we will discuss it by the way of example. Now we will discuss the calculation of tax as per section 115 BAC on the basis of such example. Mr. X, his total income is 12 lakh rupees. Mr. X, his total income is 12 lakh rupees. In the previous year, 20 and 21. 20 and 25, comprising the income from house property and interest on fixed deposit. Means such 12 lakh rupees contain income from house property and interest on fixed deposit. Now, there is a requirement to compute. There is a requirement to compute his tax liability. What will be the tax liability for the assessment year 20 and 21? There is a requirement to calculate tax liability for the assessment year 21 and 22, where his age, number 1, 45 years, number 2, 63 years, and number 3, 82 years. And 82 years. What will be the tax liability when his age 45 years, 63 years, and 82 years? Now we will calculate what will be the tax as per section, as per section 115 BAC, as per section 115 BAC, as per section 115 BAC. So we will compute tax. So when number one, when his age is 45, when his age is 45, up to 2,50,000 it is nil, up to 2,50,000 it is nil. More than 2,50,000, but up to 5 lakh, up to 5 lakh it is 5%. Is that it is 0? Sorry, 0, and is equal to 5 lakh minus 2,50,000 into 5%, into 5%, 12,500. More than 5 lakh, up to 7,50,000. In this case, the tax rate is 10%. Is that 7,50,000? His age is more than 7,50,000, up to 5 lakh into 10%. It is 25,000. It is 25,000. Computation of tax liability is 25,000. 1 second. Yeah. As per the example, assume that he has not opted the provision of section 115 BAC. Means he has not opted. He has not opted section 115 BAC. So normal provision, according to normal provision. Up to 2,50,000 it is nil. More than 2,50,000 but up to 5 lakh, it will be 12,500 rupees, means 5%. It will be 5%. In the next case, more than 5 lakh but up to 10 lakh, so it will be up to 10 lakh, it will be 20%, up to 20%. So 12,500. So it will be 12,500 plus 12,500 plus 10 lakh minus 5 lakh into 10 lakh minus 5 lakh into 20%. 20%. Sorry, is equal to 10 lakh minus 5 lakh into 20%. 20%. It is 1 lakh plus 12,500 rupees. 12,500 plus 12,500 plus 12,500, and or say we can consider is only 1 lakh. Sorry, is equal to 10 lakh minus 5 lakh into 20%, 1 lakh, and more than 10 lakh, more than 10 lakh, more than 10 lakh, more than 10 lakh. In this case, the rate will be 30%. So the 30% is equal to, the income is 12 lakh. The income is 12 lakh minus 10 lakh into 30%, 60,000. So the total tax 1,72,500. Total tax when his age 45. 1,72,500. This is tax. Now we will add cess at the rate 4%. So cess will be is equal to this into 4%. So the total tax payable 1,79,000 tax payable. Total tax payable will be 1,79,400. 1,79,400. In the case when his age is 45. When his age is 45. Number 2, when his age is 63. When his age is 63 years. In this case, up to 3 lakh. Up to 3 lakh. It will be 0. It will be 0. And more than 3 lakh but up to 5 lakh. More than 3 lakh but up to 5 lakh, 5% is that 5 lakh minus 3 lakh into 5%, 10,000. More than 5 lakh but up to 10 lakh is equal to 10 lakh minus 5 lakh into 20%. And more than 10 lakh means 12 lakh. The income is 12 lakh less 10 lakh into 30%. So the total tax which is required to be paid by such person is 1,70,000. This is the amount of tax plus cess at the rate 4%. So it will be 1,70,000 into 4%. So the total tax which is required to be paid is 1,76,800. 1,76,800. Total amount of tax. Tax payable is 1,76,800. In the third case, when his age is 82 years, when his age is 82 years, in this case, up to 5 lakh, it will be 0. Means no tax will be there. Up to 5 lakh, it will be 0. Such point will not be there. More than 5 lakh, but up to 10 lakh. More than 5 lakh, up to 10 lakh, 20%. So it will be 1 lakh. And more than 10 lakh, 30%. So the tax which is required to be paid by him is the total 1,60,000 tax, and cess will be cess at the rate 4%. It will be 1,60,000 into 4%. So is equal to 1,66,400. This is the tax payable. Tax payable is 1,66,400. 1,66,400. So on the basis of such an example, we have understood how to calculate the amount of tax. How to calculate the amount of tax when the person has not adopted the provision of section 115 BAC. Section 115 BAC is not adopted by me and adopted by the assessee, and on the basis of the example, we have understood how to calculate tax in the case of different age. Now, in our previous slides, we have discussed the taxation of individual, HUF, AOP, BUL, and artificial judicial person. Now, what will be the tax rate in the case of firm and LLP? What will be the tax rate in the case of firm and the LLP? In the case of firm and LLP, the whole income, the total income of the firm and the total income of the LLP will be taxable at the rate of 30%. In the case of firm and in the case of LLP, the total income will be taxable at the rate of 30%. For the example, there is a LLP and its income is 10 lakh rupees. Its income is 5 lakh rupees. Then it will be taxable 30%. There is no any slab. Everything or the total amount will be taxable at 30%. So 1,50,000 rupees will be paid as tax plus cess is equal to 1,50,000 into 4%. So the total net tax, total tax is required to be paid is equal to sum 1,56,000 is the total amount of tax which is required to be paid by the LLP. So LLP will pay at the rate of 30% or firm will pay the tax at the rate of 30%. In the case of local authority, on the whole of the income 30%. Means in the case of local authority, the total income will be taxable at the rate of 30%. The total income will be taxable at the rate of 30%. Where the total income of the local authority is not exceed 10,000. If it is not exceed 10,000, means in the case of local authority, if income, number one, income not exceed 10,000, then 10% of such income. 10% of total income where the total income not exceed 10,000. Where the total income is not exceed 10,000. Where the total income exceed 10,000 but not more than या फिर और say not but up to 20,000. In this case 1,000 plus 20% of excess of 10,000. 1,000 plus 20% of excess of 10,000. 1,000 plus 20% of excess of 10,000. And number 3, total income exceed 20,000. In this case 3,000 plus 30% of excess of 20,000. 3,000 plus 30% of the amount by which the total income is exceed 20,000. Means in the case of local authority, this will not consider the provision of local authority is as follows: where the total income of the local authority is it is not more than 10,000, then the tax rate will be 10%. If it is more than 10,000 but up to 20,000, then the tax rate will be 1,000 rupees plus 20% of 10,000, 20% of excess of 10,000. And where the total income of the local authorities exceed 20,000 rupees, then the tax will be 3,000 rupees plus 30% of excess of 20,000. For the example, there is a local authority There is a local authority, and the income, total income is 50,000. Total income is 50,000. Then the tax will be up to, sorry, up to 10,000. Up to 10,000 income, it will be 10%. Means 10% of 10,000 into 10%, 1,000 rupees. More than 10,000, up to 20,000. Up to 20,000, so it will be 20,000 minus 10,000 into 20%, into 20%, into 20%. Now more than 20,000, more than 20,000, then it is more than 20,000 is 30,000. 50,000 minus 20,000, total income is 50,000 into 30%, 9,000. So the total tax will be 12,000. Total tax, this is the tax plus cess at the rate 4%. So it will be 12,000 into 4%. It will be is equal to sum. So the total tax payable is 12,480 rupees. 12,480 rupees is the tax payable in the case of local authority. In the case of local authority. So on the basis of such an example, we have understand how to calculate the tax, how to calculate the amount of tax in the case of local authority, in the case of local authority. So in the case of company, normally, first we will discuss in the case of domestic company. In the case of domestic company, if the total turnover, in the case of domestic company, if the total turnover of such a company or gross receipt in the previous year 2018 and 19 less than equal to 400 crore. If the total turnover or the gross receipt of the domestic company in the previous year 2018 and 2019 is up to, means less than or is equal to 400 crore, less than is equal to 400 crore, then the income will be taxable at the rate of 25% of total income. Then the income will be taxable as 25% of total income. For the is that if in the previous year 2018 and 19, if turnover or gross receipt is up to 400 crores, then the 25%, then the income will be taxable at the rate of 25% in the case of company. And in the normal case, in other case the tax rate will be 30%. If the turnover in the previous year 18-19 is less than or up to 400 crore, then the tax rate will be 25%. In all other cases it is 30% in the case of domestic. In the case of domestic company, now we will discuss it by the way of example. There is a company ABC, and the turnover in the previous year 2018-19 is 250 crore. It is 250 crore. In the previous year 2020 and 21, income earned or the amount of income or say the profit. The profit is 20 lakh. 20 lakh. Okay. So in this case, as per the provision, if in the previous year 2018 and 19, the amount of turnover is up to 400 crore, then the tax rate will be 25%. So in this year, the income will be taxable at 25%. Means the tax amount for previous year 20 and 21 will be assessed in 21 and 22, means in the assessment year 20 lakh into 20 lakh into 25%. 20 lakh into 25% means 5 lakh. 5 lakh is the amount of tax. Plus cess 4% is equal to 2 lakh, 5 lakh into 4% means the total tax. Total tax which is required to be paid is 5 lakh 50,000. 5 lakh 50,000. Next example, there is a XYZ. There is a XYZ company. In the previous year, the amount of turnover is, for example, in the previous, the amount of turnover is 500 crore. 500 crore. And in the current year, the profit or income is profit or taxable income. Taxable income is, it is 5 lakh. It is 5 lakh only. In this case, the tax rate will be 30%. The tax rate will be 30%. So the tax will be 5 lakh into 30% plus cess is equal to 1,50,000 into 4%. Into 4%, 6,000. So the total tax which is required to be paid is 1,56,000. 1,56,000. It is 1,56,000 rupees. So if the total turnover or the gross receipt in the previous year 2018 and 19 up to rupees 400 crore. 400 crore, then the income will be taxable at the rate 25%. In all other cases, in the case of company, in the case of domestic company, the income will be taxable at 30%. In the case of domestic manufacturing company, the company which is set up or registered, the company which is set up or registered on or after 1st October 2019. The company which is registered or which is set up on or after 1st October 2019 and commence manufacturing of the article or things. Start the manufacturing of articles or things before 31st March 2023. Start the manufacturing of the article and things before the 31st March 2023. Excising the option under section 115 BAB means 15% of income. 15% of the income derived from or incidental to manufacturing or production of an article or thing. Is that if there is any company which is the manufacturing company and it is registered or set up on or after 1st October 2019 and commence the business or start the manufacturing of article from before the 31st March 2023, then they can exercise the option of section 115 BAB. According to section 115 BAB, they are required to pay 15% of income. They are required to pay 15% of income which is derived from the or incidental to the manufacturing or the production of an article or thing. Means they will pay only 15% of such income. In the case of domestic company, In the case of domestic company which is exercising the option, in the case of domestic company which is exercising the option under section 115 BAA, when there is any domestic company which is exercising the offer, sorry, which is exercising the option, there is a company which is exercising the option under section 115 BAA, then the tax rate will be 22% of total income. 22% of total income means section 115 BAB, the tax rate will be 15%. Section 115 BAA, section 115 BAA, 22% of total income is that when there is any domestic company adopt the section 115 BAA or section 115 BAB, as the case may be, subject to the certain condition. In this case, the total income of the company would be computed. In this case, the total income of the company would be computed before, means giving the effect to the without giving the effect to deduction, means there is no deduction applicable under section 10 AA, 32 AD, 33 AB, 33 ABA, 35 AD, 35 triple C, 35 CCD and 80 IA to 80 RRB. Means under section 115 BB, BAB and under section 115 BAA, the deductions under section 10 AA, 32 AD, 33 AB, 33 ABA and 35 AD, section 35 triple C, section 35 triple, section 35 CCD and deduction under section 80 IA to 80 RRB will not be applicable. Will not be available. Only deduction under section 80 JJAA and under section 80M is available. And deduction of additional depreciation. Deduction of additional depreciation will also not available. Will also not available and without setting of brought forward losses, means there is any organization which is adopting or which is paying the tax under section 115 ABA or 115 ABA, sorry, BAA, then the benefit of carry forward, sorry, set off of brought forward of loss is not available and set off of unobserved depreciation is not eligible. This option is not eligible, but they can pay the tax or they will pay the amount of tax at the rate of 15% in the case of section 115 BAB and 22% in the case of section 115 BAA. 115 BAA. Now, the previous provision in the case of domestic company. Now we will discuss the tax rate in the case of company other than domestic company. Means now we will discuss what will be the tax rate, what will be the tax rate in the case of company, the company which are not the domestic company, which are not the domestic company. Normally, royalty and the fees for rendering technical service which is received from the government. Wait. In the case of other than domestic company, in the case of other than domestic company, number one, the amount of royalty and fees for rendering the technical services which is received from government or an Indian concern, when there is any amount of royalty fees, when there is any amount of royalty fees which is received, when there is any amount of royalty or fees from technical services which is received from government, which is received from the government or from any Indian concern, or which is received from any Indian concern through an agreement, and it is approved by central government, and it is approved by central government, made by the company with the government, and it is made by the company with the government of India or the Indian concern between the 1st April 1961 and 31st March 1976. And between, in the case of royalty, it is made between 1st April 1961 and 31st March 1976 and between 31st March 1964 and 31st March 1st March 1964 and 31st March 1976 in the case of fees from rendering the services. Then the tax rate will be 50%. Then the tax rate will be 50%. Is that if there is any company which is receiving the amount of royalty or the fees from technical services, and such income is received from the government. It is received from the government or from any Indian concern, and it is approved by, and there is an agreement, and such agreement is approved by the central government. Such agreement is approved by the central government, which is made by the company with the government or Indian concern between 1st April 1961 and 31st March 1976 in the case of royalty, and between 1st March 1964 and 31st March 1976 in the case of fees for rendering services. So the tax rate will be 40%. The tax rate will be 40%, and in other income, in the case of other income, it will be 40%. Means in the case of company other than domestic company, if there is any income from royalty, income of royalty and fees from technical service from the government, then it will be taxable at the rate 50%, and all other income will be taxable at the rate of 40%. All other income will be taxable at the rate of 40%. Is that for the example? For the example, there is a company. There is a ABC company. It is a foreign company. It is a foreign company, and it is received royalty. It is received royalty income from government, from India government of rupees 2 lakh, and other income earned by such foreign company in India is 5 lakh. In such case, such a royalty income will be taxable at 50%. It is received from government with an agreement, and such income, other income will be taxable at 40%. Is that 2 lakh will be taxable as 50%, and such 5 lakh will be taxable as 40%. Total tax will be, in the case of a non-domestic company, the cess is 12,000. This is the amount of tax and this is the amount of cess. Total will be this plus this. 3,12,000 is the total amount of tax which is required to be payable by such a non-domestic company. The above rate are prescribed by the Finance Act 2020. The above rate are given by the Finance Act 2020. However, in the respect of certain type of income as computed below, the Income Tax Act has been prescribed specific rate. Now we will discuss some specific income, and in the respect of these specific income, the Income Tax Act 1961 provided a specific rates. Number 1, long-term capital gain. Number 1 is long-term capital gain. Section 112. Long-term capital gain. Other than long-term capital gain which is taxable under section 112A, is that it will cover long-term capital gain, but it will not cover the long-term capital gain which is taxable under section 112A. We will discuss it in our chapter 4, means in our another chapter, capital gain. Then the capital gain will be taxable at the rate of 20%. The capital gain other than section 112A will be taxable at the rate of 20%, as per section 112. Now section 112A, capital gain on the transfer of, when there is any capital gain which is arising on the transfer of any equity share. When there is any capital gain which is arising on the transfer of equity share in a company, and transfer of the unit of an equity oriented fund when there is any long term capital gain which is arise on the transfer of units of equity oriented fund, units of equity oriented fund, and the long term capital gain which is arise on the transfer of unit of business trust, unit of business trust. Then and the condition for availing the benefit for this concession rate, for this concession rate is that if there is any person who wants to use such rate or want to avail such benefit, then there is a condition that the STD is required to be paid. The STD is required to be paid. In the case of capital assets, in the case of capital assets, just like in the case of equity share in the company, the payment of STD both at the time of acquisition and at the time of transfer is that you will pay the amount of tax on the long-term capital gain at the rate 10% on the transfer of equity shares in the company, on the transfer of unit of an equity-oriented fund and unit of business fund. Unit of business fund in case when the long-term capital gain is more than 1 lakh, when the amount of long-term capital gain is more than 1 lakh. But there is the condition that you are required to pay STD. STD on the equity share at both the time means you will pay STD at the time of acquisition of equity share and at the time of transfer of equity share, and a unit of equity oriented fund or unit of business trust at the time of transfer only. If you pay at the time of transfer the amount of STD, then you can avail such a benefit. Means in this case you will pay the amount of tax on such capital gain only at the rate of 10%, only at the rate of 10%. If such condition is not satisfied, if any of the condition is not satisfied, then you will require to pay the tax at the rate 20%. You will require to pay the tax at the rate 20%. Note, long-term capital gain up to 1 lakh is exempt. In this case, if the amount of long-term capital gain or which is arise on the transfer of equity share or unit of equity oriented fund or unit of business trust, then up to 1 lakh it is exempted. If it is more than 1 lakh, then it will be taxable at the rate 10%. Is that for the example, the long-term capital gain will be taxable at the rate 20%. 20% under section 112. Under section 112. Section 112. But as per section 112A, if there is a transfer of, there is the transfer of equity share. Number one, equity shares of the company. Number two, units of equity oriented fund, equity oriented fund, and unit of business trust, units of business unit of business trust. Okay, and the condition and transfer of this and the condition of STD payment is complete, is done, then the tax rate will be 10%. Then the tax rate will be 10%. And if more than 1 lakh, if the capital gain is more than 1 lakh, if capital gain is more than 10 lakh, up to 1 lakh, up to 1 lakh, capital gain will be exempt. Up to 1 lakh, the capital gain will be exempt. If it is more than 1 lakh and the STD paid, if it is more than 1 lakh and the STD paid, then the tax rate will be 10% only. Otherwise, if any of the condition is not satisfied, means if the STD is not paid on the transfer of equity share, on the transfer of unit of equity oriented fund, and on the transfer of unit of business trust, then the tax rate will be 20%. And in the case of all other capital assets, the long-term capital gain will be taxable. The long-term capital gain will be taxable at the rate of 20%. At a rate of 20%. Third point, section 111A. Section 111A. Short-term capital gain. Short-term capital gain. If there is any short-term capital gain which is arise, if there is any short-term capital gain which is arise on the transfer of equity shares in the company. If there is any short-term capital gain which is arise on the transfer of equity share in the company, unit of equity oriented fund, and unit of business trust, and the condition for availing the benefit is that for availing such benefit means if there is any short-term capital gain on the transfer of equity share of the company, unit of equity oriented fund, unit of business trust, then such short-term capital gain will be taxable at the rate of 15%. But there is a condition that number one, the transfer of sale of such equity share unit should be entered on or after 1st October 2004. Means such a transaction is to be made after the 1st October, on or after 1st October 2004. And the second condition is the STD is required to be payable. Means the transaction should be chargeable to STD. It should be chargeable to STD. So in this case, if there is any capital assets transferred and the capital asset is equity share in a company, and the capital assets is equity share of the company, unit of equity oriented fund, and a unit of business trust, and such sale is made on or after the 1st October 2004, and STD is paid or the STD is chargeable, then such a short-term capital gain will be taxable at the rate of 10%. It will be taxable at the rate of 10%. Is that for the example? There is a short-term capital gain on the transfer of equity share of a company, unit of equity oriented fund, and a unit of business trust, and the unit of a business trust. And the condition is that the sale is made or the transfer is made on or after 1st October 2004. On or after 1st October 2004 it is made, and STD charge. STD is chargeable. So in this case, the tax rate will be 15%. The tax rate will be 15% if all conditions are satisfied. If all the conditions are satisfied. In the case of when there is any winning from lottery, winning from crossword puzzles, winning from races, including horse race, card games, and the other game of any sort, gambling or betting of any form or nature. In such case, such income will be taxable at the rate of 30%. Is that as per section 115 BB, if there is any person who earn any income or if earn any winnings from the lottery, crossword puzzles, from the race, from any card game, gambling on betting, then such income will be taxable at the rate of 30%. Then such income will be taxable at the rate 30%. Is that for the example? Mr. Ram, he earned 50,000 from card. Then such 50,000 will be taxable. 50,000 will be taxable at the rate 30%. It will be taxable at the rate 30%. So the tax will be 50,000 into 30%. So the 15,000 is the tax which is required to be payable on such income which is earned from card game. Next is section 115 BBE. Section 115 BBE. If there is any unexplained money, unexplained expenditure, unexplained investment, then it will be considered or deemed to be the income. It will be deemed to be the income under section 68 and 69 and 69A or 69B or 69C and 69D, and it will be taxable and it will be taxable at the rate 60%. At the rate of 60% means if there is any unexplained income, unexplained expenditure, or unexplained investment, then it will be taxable at the rate of 60%. It will be taxable at 60%. What is the meaning of unexplained money investment? And it will attract 60% of tax. In order to control the unaccounted money by avoiding the benefit of basic exemption limit, to avoid the unaccounted money, and availing the benefit of a basic exemption limit, the unexplained money, unexplained expenditure, and unexplained investment deemed to be considered as income, and it will be considered as income, and it will be taxable at the rate of 60%, and it will be taxable at the rate of 60% plus surcharge of tax, plus surcharge 25%. Surcharge 25% on the tax is that if there is any unexplained money, unexplained investment, or unexplained expenditure, then it will be considered as income. It will be considered as income under section 68, 69 or 69A, 69B, 69C and 69D, and it will be taxable, and such an unexplained money will be taxable at the rate 60%, plus surcharge at the rate 25%. Thus the effective rate of tax after including the surcharge and cess will be 78%. Means on the unexplained money or on the investment or on the unexplained expenditure, the person is required to pay the tax at the rate total is 78%. This section is introduced to avoid the unaccounted money, because when it will disclose, then it will be taxable at the total rate 78%. No basic assumption in the respect of such unaccounted money or in the respect of such unexplained money. There is no any basic exemption, or there is any no allowance, or there is no expenditure shall be allowed to the assessee under any provision of the Income Tax Act. Is that in the respect of such money, there will not be any exemption is applicable when we computing such income. Further, no setup of loss shall be allowed in the respect of such income. No setup of the losses will be allowed under section 68 or 69, 69A, 69B, 69C and 69D. Is that when we will compute the income under section 68 and 69A to 69D, then the setup of the losses is not applicable. We can't set off the losses. So on the basis of such discussion, we have complete part 1 of charge and rate of tax. In this class, we have understand the rate of the income tax which are applicable on individual, HUF, AOP, BOI, artificial judicial person, company, firm, local authority, and we have also discussed the charge or mischarging section 4 of Income Tax Act. This is part 1. In part 2, we will discuss the concept of surcharge. Means we will discuss other rates of tax. Kindly consider part 2 of such concept also, so that you can properly understand the rate of tax which is applicable on income. So thank you so much for watching this video. Okay, bye bye and have a nice day.